Hello, this is PG.
Yep, I see PG and I see
Okay.
Kathy.
Winston, I'm on here, Bruce Brown.
Yes, Bruce. Bruce, I want to introduce you to everybody just in a minute whenever we get started.
Okay, sir.
I see George has joined us. George.
Yes, good afternoon.
Good afternoon to you.
Hey, Mike, this is Chad. I'm going to have to, I've got another meeting in 1 hour, so I don't know that I'll last this whole meeting, but I'll stick around for at least an hour.
Thank
Yeah,
you.
but just let us know, Chad, when you have to leave, when you have to exit.
All right.
So Winston, you ready to go?
I am ready. I don't know whether or not we have a quorum or not. Sam, Lauren, where do we stand? Barry's with us, I see.
Yes. Hey, guys.
Hey, Barry.
Hi, it's Lauren. I am counting a quorum for right now.
You say we do have?
Yes, sir.
Okay, then I guess, Mike, before we get started then, let me introduce Bruce Brown. And I don't know if Bruce is still on the screen or your screens or not, but if he is, he can wave at us and say hello. But Bruce is a new member of the board. He was just appointed back, I believe, in December. He represents consumers in the organization of things. Bruce is the retired executive director from the Lake Cumberland Community Action Agency, which he proudly served for many years down there. And Bruce, welcome very much to the board. We're very happy to have you and look forward to meeting you in person. And you and I have met in person, but for the rest of the board. And by the way, just make a note that we're optimistically hoping that we will meet in person in April. And so when you look at your calendar, keep that as an option. We'll let you know at least 30 days in advance in a more definitive way as to whether or not the meeting is going to be in person. But please think about it as a possibility so that you can organize your schedule accordingly. And if we do, we'll have lunch before and the meeting, and then the meeting at 2 as usual. So with that, Mike, I'll turn it over to you.
Okay. Winston, what day would that be on in April? Do you know?
It will be, I believe, the 23rd of March, and I'll verify that with my calendar here while you're talking.
So it'd be the 23rd of March. Okay. All right. Okay. And Bruce, let me echo Winston and congratulate you and welcome you to the board. We're glad to have you. So,
Thank you.
So Lauren, can we confirm a quorum then?
Yes, we have a quorum and the press has been notified.
Okay, thank you. So we'll get the meeting started. So first of all, I would like to thank Winston and the board for the time I was out. I really appreciate Winston keeping me informed the best he could, and it's been a pretty tough 2 or 3 months, but I'm doing so much better, and I'm very, very fortunate. The good Lord has blessed me, and so I just want to thank the board, and Barry, I want to thank you for running the December meeting. I hear you did an excellent job, so you want to be careful. You might get that job one of these days.
No, you can keep it.
But anyway, I just want to thank Winston and the board for all you all did while I was out. I certainly appreciate it. With that, we'll get started.
Mike, let me interject. I misspoke as to the next board meeting date. It will be on April the 27th.
April 27th. Okay.
So if everybody will make that notation on their calendar.
Okay, good. All right. Thank you, Winston. Okay, so I think everybody's had a chance to look over the minutes of the meeting. If there are no objections, I would entertain a motion to approve the minutes.
He will make a motion.
Okay, we
This
have
is
a motion.
George.
Do we have
I'll
a
second it.
We have a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. The number 3, the revised inducement resolution for the path off King Run with David Stark. Do you want to tell us about that? Is David with us?
He should be. Lauren, are you showing David on?
Can you hear me now?
Yeah, there we go, David. We
Okay.
can now.
All right. I'm having some of the same issues Winston is, I guess, with my monitors. I had to unhook there. So thank you and sorry about that. Yes. Hello, everybody. I'm on. Yep. Thank you. My name is David Stark. I'm the new managing director of multifamily programs. For those of you who haven't met me, regarding this agenda item, this is a revised inducement resolution for the path off Cane Run Road. You might recall the path off Cane Run received an inducement resolution on May 26, 2022, in the amount of $17,500,000. And since that time, the project has run into increased construction costs due to demand for materials and inflation. On July 27, 2022, the developer requested an additional $2.5 million in bond authority via KHC's waiver process. KHC staff has reviewed and is requesting board approval of a new inducement resolution to reflect the new total bond authority of $20 million. This project involves new construction of 106 units located at various addresses on Cane Run Road in Louisville. The project will serve 106 households at or below 60% AMI. And there is a typo in your documents. I'm sorry, it is 106 units. And it will consist of 78 3-bedroom units and 28 4-bedroom units. The development team is listed in your packet. I won't go through all of those members, but they are there for those of you who wish to review the development team members. The recommended course of action is that the board of directors authorize the issuance and sale of tax-exempt bond. KHC staff, after our preliminary review of the submittals from the applicant, recommends approval of the board of this inducement resolution. But please know that as the financing for the project progresses, the board must also authorize the issuance and sale of tax-exempt bonds through approval of a separate resolution. So with that, I seek to get the approval, but I'm happy to answer any questions.
Well, this is Kathy, and I am thrilled at 4-bedroom units. Everyone here knows how much I love 3 and 4-bedroom units, and thank you for also including that information in presenting, because it is ultimately about the households we serve. So with that, I would move. Do we need 2 things? So I move for the first one, or do I get both of them in one motion?
No, we're only seeking approval of the revised inducement resolution.
Okay.
At the higher amount.
I so move.
Thank you.
A second, Ms. Holly.
Mike, are you still there? Mike may have stepped away from his desk momentarily. Let's
I believe his microphone was muted.
Oh, is he back with us? Mike, you may be muted.
I'm sorry, I was I went to another computer because I thought it was more reliable, but
Okay.
obviously it isn't. So,
Well,
can you hear me now, Winston?
We have a motion and we have a second.
Okay.
On the pending item.
Okay. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. Okay, David, inducement resolution for Davis Park 2, Phase 2.
Yes, thank you. Again, also at this time seeking an inducement resolution for the named project, Davis Park Phase 2. They are requesting bonding authority in an amount not to exceed $9 million. This project involves new construction of 72 units located at 757 DeRue Street in Fayette County in Lexington. Again, apologies if I'm mispronouncing that street name, but the project will serve 72 households at or below 60% AMI. And the 72 units of this project consist of 24 one-bedroom units, 36 two-bedroom units, and 12 three-bedroom units. Again, the development team is listed in the packet for your review. Again, like I mentioned on the last agenda item, this is only the inducement resolution. The board must also, at a later date, authorize issuance and sale of tax-exempt bonds through approval of a separate resolution. So at this time, KHC staff has reviewed the preliminary submittals of the applicant and recommends approval by the board of this inducement resolution authorizing tax-exempt financing for Davis Park Phase 2. I'm happy to answer any questions about this one.
Any members have any questions of David? If not, I'll entertain a motion to approve the resolution. Someone?
I'll
So
move.
moved, Mr. Chad.
Okay, we have a motion, and do we have a second?
Kathy, I'll second it.
Okay, thank you. All right, all in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. Okay, David, final resolution for Richwood Bend.
All right, so now we're moving on to a final resolution. Thank you. Richwood Bend is a project that was granted an inducement resolution on May 26, 2022 for bond authority in the amount of $10 million. This is the final resolution for $10 million. The project received a TEPR hearing back in October of 2022 and has been through the State Property and Building Commission as well as Capital Projects and Bond Oversight Committees. This project involves 83 units located at 100 Cottle Drive in Lexington. The project will serve families at or below 60% area median income. And this project of 83 units consists of 24 one-bedroom units, 24 two-bedroom units, and 35 three-bedroom units. Again, this is a final resolution, and staff does recommend approval by the board of this final resolution for the issuance of bonds for Richwood Bend. Again, development team is listed in the materials if you wish to review those. But otherwise, I'm happy to answer any questions about this project.
Any members have any questions of David in regard to this resolution? If not, I'll entertain a motion that we approve.
Steve will make a motion.
Thank you, Steve. Do I have a second?
This is George. I'll second.
Thanks, George. We have a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. Okay. Thank you, David.
Thank you.
Appreciate your hard work on these resolutions. Stephen, you need to talk about the report of action recommendations of the Finance Committee that was held last week. And if you would take that over, I'd appreciate it.
Yes, sir. Thank you very much. Good afternoon, everyone, and welcome to our new member, Bruce.
Thank you.
Yes. The Finance Committee of the Board of Directors of the Kentucky Housing Corporation. We did meet virtually on February the 23rd. Unfortunately, that day I had a funeral of a very good friend who died after a long illness with cancer, so I was not able to attend. But in my absence, Secretary Holly Johnson was elected Chair Pro Tem, and of course ran the meeting. Thank you very much, Holly, for stepping in.
No problem.
The first order of business was a swearing in of our new board of directors and finance committee member, Mr. Bruce Brown. Again, welcome, Mr. Brown, to the committee. Jim Statler then presented the financial update for the corporation as of December 31, 2022, showing that although the corporation was profitable for the first 6 months ending December 31, the results were not as robust as in the past several years, explaining the major reasons why, which he is on the agenda. Of course, we'll go into that. Jim also presented a report on the secondary marketing trading results for the first half of fiscal 2023, showing that actual trading gains totaled just over 1.5 million, which again was well short of the plan. Jim explained that the mortgage market continues to experience tremendous volatility and pricing difficulties in light of the very rapidly rising interest rates. He advised the committee that the corporation has changed its pricing metrics to increase cash gains while trying to maintain adequate production volume. Jim then presented a summary schedule on the single-family servicing portfolio, reflecting continuing increases in principal balances from June to December, reversing the recent downward trend that had resulted from the sharp drop-off from last year's high level of mortgage refinancing activity, again due to the rapidly rising interest rates. The weighted average servicing fee rate also increased very slightly from June to December. Again, Jim is on the schedule today and will brief us all more on the numbers behind all this. He did present a schedule of loan delinquencies, highlighting the impact of the end of COVID loan forbearance. Both overall levels of delinquency and the severity of the defaults showed a marked improvement. As the various end of forbearance relief options continue to work through the portfolio, it is anticipated that defaults will continue to improve. Finally, Jim advised the committee that because of the current market conditions, that although the secondary market mortgage purchase program remains the preferred method of funding our single-family loan production, management has on the agenda today a resolution approving the development of a financing plan to issue housing revenue bonds as a way to supplement our secondary market production. Mr. Chairman, that concludes my report. There are no board action requirements that are needed today. Thank you very much.
Thank you, Stephen. We appreciate your hard work and the efforts of the committee. Lauren, we don't need a motion to accept this report, do we?
No motion is required.
Okay, thank you. All right. So next item is presentation of the Kentucky Housing Corporation financials from Jim Statler. Jim?
Thank you, Mr. Chairman. Good afternoon, everybody. This is essentially the report that I presented to the Finance Committee last week. Not a whole lot to embellish it with, and Steve's covered a lot of the high points of it, and I'll go into some of the reasoning for why certain numbers are a little untoward relative to prior years. Yes, starting with the schedule we have there, let's go to line K, and you see that net position before mark-to-market actually increased 2.4% from $444 million to $455 million. Then proceeding down to line M, you can see that mark-to-market took a big chunk of that out, but our overall net position as presented on a GAAP basis did increase a little just short of $4 million, which considering the difficulties in the market, I'll take that. I think the most telling item on this schedule here is the last two lines, line N being the size of the loan servicing portfolio that's not on the books, but is a big income generator. It increased 5.7% since June. Those of you who have been on the board for a number of years saw that portfolio shrinking just a little bit as refis ate into the portfolio and we were not able to replace it. Refis have disappeared. Nothing is paying off, and so all of our production is contributing nicely to the overall outstanding of the service for others. And then we've also been able to make a little bit higher net servicing fee from 31.5 basis points to 31.8 basis points. That's on line O. That is a favorable figure as well. That number had dropped due to pricing robustness, if you will, of our pricing in years past. And now that pricing is not so good from an overall standpoint, we're able to get just a little bit higher servicing fee. Again, that's an annuity. We have a $2.5 billion asset earning 31.8 basis points gross on an annual basis. So it's a fairly big asset off the balance sheet that's generating pretty good revenue. Going to the next page, which is the pro forma statement of revenues, you can see that again, going down to line O, where the change in net position of $3.7 million. That's what we saw on the previous page. That compares to an increase in net position from the 6 months ended 12/31 of 21 of $19 million. The high profile points there are really just two. Mark to market. As rates go up, our investment portfolios lose value. It is a non-cash loss, and it becomes a cash loss only if you sell the securities at a depressed value, which we have absolutely no intention nor need to do. And so we will earn that back either as the price in the securities increases or as we receive payments on those securities at par. And so while it does diminish the income statement as reported, it is not a cash loss. Conversely, if you go to line D, you can see that there's been a $9.4 million drop in gains on sale of loans. This is no secret. It was showing its ugly head toward the end of fiscal 22 and really high profile now here in fiscal 23. As Steve mentioned in the write-up, and as I informed the finance committee, we've changed the metric of our pricing to try to get a little bit more gain recorded, but at the same time keep the volume coming. And I'll have a small schedule showing that through this, even though we're not making a lot of marketing gains, we are able to make a lot of loans. And that we take heart in. That is our mission, is to make loans to people that can't get loans otherwise. And so, and for a lot of our lenders, we're maybe the only game in town because we have down payment assistance that we can help make first-time home buyer loans. So that is a bright spot in that we are able to continue to keep the volumes up, albeit not making a whole lot of money like we have in years past. One notation I want to make, and I mentioned this to the finance committee as well. Line A for fiscal 22 is overstated by about $700,000, and line H is overstated by about $700,000. That's a classification issue that cropped up pretty much just in the second quarter of the fiscal year so far, and that has been corrected. But we'll see the impact of, particularly on line H, when the general administrative expenses, when we go through the BVAs in just a couple of minutes. Overall, I'm not thrilled with our bottom line, but I certainly am okay with it, given the difficult environment that we're operating in. So no surprises. It tells the story that we've actually been living, and we're working hard to get the bottom line up just a little bit, but at the same time keep the mission going out there and helping the people in the Commonwealth. This schedule, which is a cash flow statement, there's a couple of items here. You can see on line B, the huge decrease in the amount of cash flow outflows from non-capital financing activities. Fiscal 21 had the lion's share of the pension payment made out of it. And so that was a fairly large number that we paid out, and had the pleasure of not having to pay it out again then in fiscal 22. And then similarly, if you look at the set of numbers at the bottom, the significant loan and debt line items, those numbers are not demonstrably different this year versus last. That's an indication that we are able to keep up our production volume, because that's what these are indicators of. And so we, despite the fact that we have decreased losses or decreased gains, the amount of production going through the corporation has remained just off a little bit. And then one item of note, line I, where you can see repayments on housing mortgage loans dropping from 39 million to 23. That's an indication. Again, it's the story we read about, we hear about. Payoffs are gone, refis are gone. Everybody's holding on to their loans, and so that activity has come to a grinding halt. And when you see that the lending activity has dropped by 80%, that's where the 80%'s dropped. It's on the refis and the bottom 20%, which is the purchase transaction, that's pretty much the business we're in, and we've been able to hold our own, keeping that production level up. Going more to the on budget as opposed to the financial statement presentations on this schedule, I'm going to the next to last column, the dollar variance column, and going to zero in on line E, where the fee income generated from most of the temporary COVID funds and initiatives is well under budget, as the HHERF program is sunsetting, and the HOPE program is still not going on all cylinders, but it's not generating the revenue that we had budgeted. One item about this number is, even though the revenue is down by $2.4 million, the expenses that we incur that revenue reimburses are also down by $2.5 million. And so net to our bottom line and cash flows, that is neutral. Going to the middle section there, line G, loan servicing income is up $500,000 over budget. That's a phenomenon of the end of COVID forbearance program, where in all those delinquent payments, and there were thousands of delinquent payments, was an embedded servicing fee that we didn't earn until we got those payments. Well, with HUD making all those payments via claims to us, we're collecting 15 to 24 months of servicing fees on loans that we didn't get any servicing fee income in years past. Those numbers were not budgeted, and therefore they're showing a positive budget variance this year. The next line H, rental production. Rental production, those are the bond issues that you just passed resolutions on. Those get recorded when they close, and there's a timing issue on that. Generally, what we can say here is that activity is on budget. We just got more closed in the first half of the year than we anticipate closing in the second half of the year. Home ownership, a little bit of a disappointment. It's down $347,000 budget versus actual. There's two main fee items in there. One is an origination fee, and the other one is a late delivery fee. And with 80% of our lenders' business now not taking place, our lenders are delivering their loans on time to us. When the other 80% was in vogue last year, they were delivering late to us. And when they deliver late to us, they pay a fee to deliver for the privilege of delivering late. And so we budgeted that would continue going into fiscal 23, but everybody's delivering their loans on time, so we don't have the opportunity to charge those late fees. And as I said, if you go to line N, there's the shortfall in revenue that we're experiencing, $1,542,000. Line O, we're enjoying a shortfall in expenses of just short of $2 million. So we were actually, on a net basis, running about $411,000 positive to budget. Excuse me. Just a couple highlights on the actual expenditure. This is the detail of line O on the prior page. You can see, and again, I'm dealing in the next to last column, dollar variance. We have favorable variances on all of the comp and benefits and business services and contract services. Again, those were the expenses that we budgeted to incur on primarily the HHF COVID program that we did not incur. So we're favorable to budget there, causing unfavorable on the revenue side. I want to go to lines G, which is foreclosure costs and release fees, and line O, which is liquidation shortfall. Those two lines are overstated on the year-to-date actual column by the $700,000 I mentioned when we looked at the income statement. And so the revenue was overstated on the income statement by $700,000. These two counts collectively are overstated on the expense side by $700,000. So absent that, both of those would be showing a positive variance year to date. And again, that got corrected. It was a new phenomenon that we experienced in the second quarter, and we got that tracked down, and we'll have corrections, and we won't have to mess with that again. Then the equipment and software budget is favorable. Line M, $311,000. That again is a slowdown in new computer equipment as some of the COVID programs wind up. And then the apparent negative variance on line Z, which is the Kentucky Affordable Housing Conference. That's a timing difference. We incurred and recorded all the expenses prior to December, but the main revenue, which is the attendance fees, did not get recorded until January. We didn't get them from the event organizer until January. And so overall, if you put yourself in our shoes a year ago, trying to predict what this year was going to look like, and we came up with a good faith budget. The actuals are are not coming in the same. They are coming in with variances, but the variances support the story of reduced activity here and reduced gains and losses or gains on the sale of loans. So everything makes sense. We'd like to see more gains, but we'll take what we can get, and that's where we are. Any questions on the financials? I have some summary statistical information that I'll rush through, or not rush through. I'll go through and expand a little bit on some of the stuff that I've already talked about.
Tim, just let me say, you and the staff at KHC are to be commended for the job you've done this year in light of, because it's been so tough. I do want to just mention that the net decrease in value of securities, which 7.2, that started about this time last year. And I point to three things. One is higher interest rates, inflation rate, and then the Ukraine war. And that's when the bond markets really started to take a hit. So in light of all this, I think you all have done a really good job. Do any members have any questions of Jim before he proceeds here? Okay, Jim, go right ahead.
All right, thank you for your compliments, Mike, and I'll make sure I share that with staff. They like to hear it from the top, and it doesn't get any topper than you, so we'll make sure we share it. On this schedule here, the yellow is fiscal 22 December, the blue is last year, December 21, and the tan is December of 2020. And I think in that first schedule, you can see in the notional amount, the second column from the left, you can see that we've been able to maintain production volumes, as I stated. But then when you look at the gains in the next column, the gains in 2020 were $21 million, last year $11 million, and this year $1.5 million. And it's a tough market out there. I think the new mantra now that I'm hearing is higher for longer, and that they think the rates are going to, prevailing wisdom now is rates are going to continue to go just a little higher than they thought they were going to go, and last a little longer at that level than they thought they were going to last. So we are ready for it, but we'll have to suffer through it with the rest of the company, with the rest of the country. Going down to the servicing portfolio highlights is the three sections in the middle. Again, there's an illustration that the total single family portfolio, which includes the bonds and the warehouse, is at $2.858 million, which is up from last year, but last year was down from the year before. And so, the payoffs have disappeared, where we were trying to outrun payoffs in 21 and not successfully getting more loans in than we were having pay off. But now payoffs have disappeared, and we are, again, growing the portfolio. I have a visual of that in just a second. Then the weighted average servicing fee, which is the other stat on the first page of the financial statements, you can see that it has increased, albeit just modestly, but increases are better than decreases. And that just means that the revenue stream being generated by the portfolio is higher today than it was this time last year. And then I think a very illustrative chart is where the 90-plus day delinquencies are down to 1.78 now. This time last year, they were at 404, and the year prior at 391. That is the pent-up payments that were stuck in all the COVID forbearance loans, the lion's share of which have moved through and have been resolved. And was, as Steve mentioned, there is a resolution. We've looked at the secondary market mortgage mortgage purchase program, and we feel that there might be some additional loans that we can make by issuing some tax-exempt bonds. We do have some tax-exempt bond authority carried forward from 2020 or 21. I can't remember exactly. It's about $135 million. Excuse me, that we hope to be able to use to make loans at a little bit lower rate to folks that cannot afford the higher rates in the secondary program, but we can get some of these folks, first-time home buyers, into some affordable housing. Next, on the next schedule, I think this is an interesting how we've come and where we're going, if you will. Who's driving the schedules? Thank you. And I'm looking at the cash gains column. third from the right, you can see, and this is the ever to date on the secondary market mortgage purchase program. And you can see that in 2020 that peaked at, or 2021 that peaked at $33 million profit on those sales. Dropped last year, and as Mike, you indicated, the rate squeeze, started in the late third fiscal quarter of us, but first calendar quarter of last year, and the pricing started to deteriorate, and it's continued to deteriorate into 23. But this does give you some appreciation, I think, of how valuable the program has been to the company, and we're not predicting that it's going to go to a loss in the future, but maybe at levels a little bit lower than we've experienced in the most recent past. This chart that is internally called the red and black chart illustrates, the red lines illustrates the earning portfolio size of whether it's on the books or not on the books. And the black line is the outstanding bond balances we have on the books. And so you can see that we've allowed the bond portfolio to shrink by cashing out whatever profits would have been earned on the bond portfolio several times fold by selling them into the secondary market. And you can see right there in the right part of the chart where after it had started ticking down just a little bit, it is now ticking back up. And that's illustrative of the fact that the portfolio is growing. And so when that chart goes up, that's a good sign. This next chart is an interesting visual, I think. Of course, I'm a bits and bytes number cruncher, but on the right side of this chart, the line that peaks is not the delinquency ratio of our portfolio, but it's the delinquent payments ratio. And so a delinquency ratio counts one loan as delinquent versus the portfolio. That blue line counts how many payments are delinquent relative to the number of loans we have in the portfolio. And you can see that as COVID hit us in the early 2020s, that blue line started up because not nobody, but we had 1,600 borrowers that stopped making payments. And the longer they held off making the payments, the more payments per loan we were delinquent. You can see that 9-10 months ago that peaked, and now that the end of COVID forbearance end games are being executed by HUD and VA and Fannie Mae, those loans are curing by those entities making all of the delinquent payments to us, which we had fronted to escrow, tax venues and insurance companies and Ginnie Mae security holders. We're getting repaid all the cash that we had fronted as those payments now are becoming, those loans are becoming current and taking out all those delinquent payments. My final chart today is a recap of our COVID portfolio, and going down to the bottom right, we had still and this is January of 2023, we still had 183 loans that were under COVID forbearance protection. In August of 2020, there were 1,639 of those loans. And so you can see that the COVID hit 1,700 of our borrowers in the face pretty early. And we've spent the last year, those loans gradually got more and more delinquent, as indicated by the blue line. And then in the last 10 to 12 months, we've worked those down to where we're down to 183 still under COVID forbearance protection. And the payments that are buried in those delinquencies have largely been realized. And so it's been a long 3 years. The charts indicate, I think graphically, what we've been through. And I think corporately, we've come through it about as best as we could expect. And as a borrower base, all of the accommodations, particularly on the home ownership side, kept people in their homes. And on the renter side, the HHERF and the rental assistance programs kept largely tenants in rental properties. And so it could have been a much bigger disaster than it was. And I'm thankful that we've been able to play our part in helping people navigate the difficulties of the last 3 years. Mr. Chairman, that concludes my comments.
Again, Jim, you all are to be commended for the work. I know it's been tough on all of us. And the three things I pointed to were three things that we cannot control. So thank you very much. Any members have any questions or comments they want to make
I just wanted it's Kathy. I was just curious how we did compared to other state housing finance agencies. Is that something anybody's been studying? Because it sounds like we weathered this surprisingly well. And I just was curious compared to other places. Realizing that other parts of the country have have industry differences.
It is hard to draw comparisons, Kathy. I do know that there were a number of state HFAs that were participating in the secondary market. And when navigating that market got really tough 9-12 months ago, many of them went to housing revenue bond financing as a better execution to keep things going. We sacrificed some of our gains to keep production, and we have a more limited bond cap available to us than a lot of states do. And so, because we share our bond cap, number one, with the private sector, and then we also share it with student loans, and we share it with internally with our multifamily. And so we don't have all that available to us from a single family standpoint. A lot of state HFAs contracted out HHERF and some of the other COVID relief programs that were out there, and with differing levels of success. I know some of the states burned through their program dollars much faster than we did. I think certain states had it worse off than we did. I'm sure there were some that didn't have it as bad off as us. But it was interesting that in my last CFO's call, which is in the Southeast HFAs, even Virginia is looking at going into housing revenue bonds, which they've been a long-term proponent of the secondary market, as have we, and they're coming to the conclusion, as are we, that there's a niche of the market that I think we can fill with housing revenue bond financing. So, but it is hard to compare our performance versus others. Some HFAs are integral parts of the state governments. They get funding from different sources, taxpayer sourcing, whereas we have to make all of our money. So it is difficult, and it does lend itself to differing approaches to resolving the problem. And I take heart in knowing where our successes were. Could they have been better? They could always have been. They could always have been better. But I'm not resting on, and neither are we resting on our laurels and saying job well done. We did as good as it could have been, because I don't believe that necessarily, but I think we did a damn good job of helping the citizens of Kentucky.
I agree. I just was trying to bring that out. So thank you.
Mm-hmm.
Any other members have any questions of Jim? Well, if not, Jim, why don't you proceed to tell us about the mortgage revenue bond plan that you've developed here?
Yes, sir. Thank you. Agenda item number 8 is requesting authorization to develop a financing plan to issue mortgage revenue bonds to provide additional funding to augment the corporation's secondary market mortgage purchase program in support of our home ownership program. As you're well aware, for the past decade, the secondary market program has provided the corporation with adequate resources to support our home ownership program. Due to current market conditions, staff believes issuance of tax-exempt mortgage revenue bonds can provide the corporation with additional resources to provide mortgage financing to low and moderate income first-time home buyers who are otherwise unable to obtain financing under the secondary mortgage market purchase program. That's largely due to rate. We can't get the rate low enough. And as prevailing rates go up, the difference between tax-exempt and taxable rates now is material enough to where tax-exempt financing can translate into lower mortgage bonds or mortgage rate financing. Excuse me. With approval of this resolution, finance staff will be meeting with external members of its financing team in March of 2023 to begin discussion of issuing mortgage revenue bonds. Management recommends approval by the board of this resolution authorizing us to proceed with the development of a financing plan. Financing plans are subject to final approval of pricing terms and conditions by the board of directors or the executive committee of the board of directors when we get to pricing and actual sale of the bonds. And This is a different resolution than what we've had over the last 10 years, where the financing plan was actually to continue to sell into the secondary market. This is now a financing plan to develop a delivery into the tax-exempt bond market.
So Jim, this is basically along the lines of what you were talking about earlier that we needed to do. We're kind of following Virginia and some of the other states, right?
Yes, sir.
On this.
Exactly. It's to get a lower rate to the street, and tax-exempt bonds can, we think, and the first big analysis starts Monday afternoon, where we have a conference call with issuing tax-exempt bonds.
And this, Kathy, I have a naive question. Will this only be even more beneficial to the people we serve as the Fed keeps increasing rates? If we get this done and lock in these, this edge of tax exempt.
Traditionally, the higher rates go, the more different, the bigger the difference between tax exempt and taxable, which makes tax exempt bonds a more viable investment to the investments community. And tax exempt interest is a real tax advantage to those folks. And so, yes, that does translate to that. We are concerned about cannibalizing some of our secondary market originations by offering, say, a 5% loan in a market that we're getting 6% loans on now. And so we're going to be careful of that. The population that can be served by tax-exempt bonds is a lower income population and a lower housing price population than we can serve in the secondary market. And so there'll be a good slug of our secondary market that cannot be cannibalized by the tax-exempt bonds. But we think that there might be a section of a piece of the population of the state that cannot afford a 6% loan, but would be able to afford a 5% loan. And we're trying to get to that part of the population and make some housing available. That was, you say, well, why wasn't that always the case? And with rates as historically low as they've been over the last 10 years, the difference between tax exempt and taxable was virtually non-existent, number one. And the prices we were getting on our secondary market products enabled us to put product out there at lower than rates relative to the market than we are able to do now because the pricing's not there. And so it's not that we could have done $800 million if we'd had a bond program running in parallel with the secondary program 4 years ago because we were getting such amazing prices for our secondary product that we were able to translate that into basically lower rates and delivery to the borrower.
So Jim, personally, I think it's probably going to be a good move for you. Any other members have any questions to Jim? If not, I'll entertain a motion that we approve this financing plan to issue mortgage revenue bonds.
Kathy,
All right, I have a motion from Kathy. Do I have a second?
I'll second this, Chad.
Okay, Chad, thank you. Have a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. Okay, so Jim, I think you're up again to talk about Freddie Mac becoming a Freddie Mac seller servicer. And I'm under the assumption that KHC has never been a Freddie Mac seller servicer. Is that correct?
That's correct. We have been in the conventional market a Fannie Mae seller servicer. In my career, I have serviced both Freddies and Fannies. They have subtle nuances between the two programs. By being a seller servicer for both, you have the ability to keep one honest versus the other. You can play them against each other just a little bit. The application process, we went through most of last year and got approved by Freddie in November. And we are in need of a resolution to where the board authorizes certain individuals in their job description capacity, so they're not named specifically, but they are named by job capacity, to use part of Freddie Mac's delivery system that will initiate wire transactions, whether incoming or outgoing. And it's like an incumbency certificate that some of you might be familiar with. It's basically authorizing people to move money within Freddie Mac's proprietary lending system. And then it also authorizes certain other individuals who are administrators to then go into those systems and specifically allow the other individuals that we're approving today to actually move the money. And this is very standard. It's like authorized signers on a checking account, if you will, but it's a very legaled up document coming from Freddie Mac that we have. We tried to get our normal signature authority and decision authority authorizations to work, and their attorney turned it down. So we've tuned it a little bit, but this basically allows us to proceed to the next step of becoming a Freddie seller servicer. This again, hopefully, gets us products that we cannot get from Fannie, and obviously can't get from Ginnie, because Ginnie Mae is strictly a government FHA VA vehicle. And so what we're asking today is authorization to a resolution authorizing certain individuals by title to execute certain transactions, and then certain other individuals authorized by title also to go into Freddie Mac's system to actually allow the people that are going to actually do the transactions to be named people to do that. It's a tough document to try to describe.
Jim, I would make a comment though, and I think this is a good move for you. I used to be a Freddie Mac servicer and seller, and they are tough. But I would also tell you that make sure your firewalls are in place, because we are witnessing in the banking industry a tremendous amount of wire and ACH fraud. It is absolutely unbelievable. And so just make sure you have all the controls in place that you need to have in place to protect a corporation.
I appreciate that. I appreciate that commentary, Mike, and it's high on everybody's list here. And the one thing that we've been very out in front of is anybody that calls in here or tries to change the destination of money that is going out must have a secondhand confirmation, verbal, from somebody at that entity that we know before we will change destination of any wires. But I mean, that's a piece of it, and I appreciate your concern, because it's a real concern.
Yeah. Okay. Any other members have any questions of Jim in regard to this Freddie Mac resolution?
It's Kathy. I know that Freddie has been very supportive of not mobile homes, but what is it called? Housing.
Manufactured housing.
Manufactured housing, and I'm supportive of that. It talked about other products that may come our way. Would that be part of it? Maybe. Someday.
If it's chattel paper, I'm personally not particularly interested in it.
No, I agree.
If it's full mortgage, attach the unit to a proper foundation. Yeah. I don't have a major problem with that. There is a perception that single wides don't hold their value as robustly, if you will, of a double wide. But you know, mobile home financing has been around forever. I bid on a 5,000 loan deal in Ginnie Mae, 30 years ago. And it's difficult servicing because of the valuation issues of the underlying property. But there's been a lot of strides made on quality of that type of product, and to just categorically say no, we're not interested is that's not on the table.
Well, I agree with chattel, although I do think some changes in law need to happen. But Kentucky, we have, we were the home of the national program for manufactured housing expansion. So that's why I asked. Thank you.
And you are not the only advocate on the board, right, Barry?
Yes, sir.
Okay, if there are no other questions, I'll entertain a motion that we approve this resolution.
Gail, so moved.
Okay, thank you, Gail. Do I have a second?
Second, Susan.
All right, thank you, Susan. So I have a motion and a second. All in favor signify by saying aye. Aye. Opposed, like sign. Motion carries. Okay, Jim, you're still up. So,
Yes, thank you, sir. This is my last. I'm about out of voice, and I'm sure you're tired of listening to me. But
we're not tired of listening to you. But go ahead.
Agenda item number 10 is a we're requesting authorization to renew a personal service contract with Kane Mitter and Associates for quantitative consulting services. What Kane does for us is they do all the number crunching surrounding the new bond issuances and the ability and cash flow projections for the rating agencies. We get rated by Standard & Poor's and Moody's, and they are a continual resource to us as we continue to measure the relative efficacy of bond issuance versus secondary market. They make money in the bond business, but they also make money in the secondary market business, and they've marketed some of our MBSs, and they have an active desk that we have not used because they charge a fee for it, and we have a pretty good execution on our own. But anyway, this is we set this out for RFP last year. They were the only respondent. They have been our quant corp company since I've been here, which is 12 years. It was for several years prior to that. They answer the phone when we call. We have good rapport with them, despite the fact that the principal we deal with is a New York Giants fan. But they are very responsive to our inquiries, and management recommends renewal of this contract with Kane for fiscal 24, not to exceed $400,000.
Any members have any questions of Jim in regard to this resolution? If not, I'd entertain a motion that we approve.
Steve will make a motion.
Okay, thank you. Have a second?
I'll second. This is Chad.
Okay, thank you, Chad. So we have a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries, Jim. And thank you very much for everything that you do and your hard work.
Thank you. It's a pleasure to present news to the board. Good news is more fun than bad news, but it's always nice to get in front of you folks.
I always learn something from you when you present this, so I certainly appreciate it. Okay, Gail Lively's up next to talk about the report of the joint meeting of the Program and Policy and Communications and Planning Committees. So, Gail, floor is yours.
Thank you, Mike. Excuse me. On February 16th, a joint meeting was held of the Programs and Policy and Communication and Planning Committee. We held that meeting to update the committee members and the board on our second quarter, fiscal year 23. Overarching strategies and how the allocation plan was discussed, and John Davidson and Kendrick Vonderschmidt will present the updates to you all right now. And I've got to tell you, they have worked hard. Great job, guys. John?
Thank you very much, Gail. Good afternoon, members of the board. I'm John Davidson, Deputy Executive Director of Business Services, and I wanted to give a brief overview of where we are on the second quarter across some of our programs. So if you will allow me to, I'll start by talking a little bit about the annual corporate planning processes, specifically by board committee. As Gail alluded to, the overarching strategies every year are crafted by the executive management team and reviewed by the Communication and Planning Committee of the board. And then the allocation plan, which is allocates all the funds that we use, over $1 billion of assets that we lay out for our programs. The Programs and Policy Committee looks at that and reviews that. And then as you heard from Jim earlier, just a few moments ago, the operating budget and updates and things of that nature, financial are presented and crafted. The operating budget pays for the mission, pays for how we're going to deliver all of these things, and that is approved and reviewed by the Finance Committee, and then ultimately all of these committees report to the board in May, forward facing. So today I'm going to talk a little bit about where we are, give a second quarter update. I'm going to start with the fiscal 23 overarching strategies, and those are, I'm going to give a high level overview. The first is providing holistic housing solutions. This is really Wendy Smith's area, and for all the programs we operate programmatically, we're looking to operate and align existing programs proficiently and partner with entities across the state, because we deliver many services and many programs and administer many programs, not solely, but with partners across the state. As you've heard, we have implemented for the last 2 years and continue to implement and administer some of the COVID relief programs. Some are coming to an end, some are sort of maintaining and staying. So I'll talk a little bit more, and I think you'll hear a little bit more about that from Wendy Smith as an informational item at the end of the meeting today. Using our data and analytics to shape our decision making. I'll give you some examples of that. And what we're doing with that, and then looking at any factors that might prevent us from delivering our programs more effectively. The second strategy is related to being flexible and responding to financial risk. This is sort of what you heard a little bit of the conversation with Jim about, making sure that we are financially able to and flexible and able to mitigate any financial risk to pay to deliver all of the missional services and administer all the programs. Obviously, you saw that in the information presented, the COVID-19 information, and loans and forbearances and all of that information. We are also looking at optimizing and utilizing our administrative fees to cover the expenses for the multitude of programs that we administer, to make sure that we can get as much of that as possible to cover our expenses. We're also evaluating opportunities to deploy these resources to support our mission, and then maintaining prudent stewardship and financial resources, and making sure we're effectively managing risks and looking for new solutions as ways to deploy resources. So, and lastly, this is sustaining and advancing core competencies. This really is keeping the lights on and making sure that we are able to operationally exist. We're continuing to develop processes and technology to ensure business continuity. That was a testament for the last 2 years. The world has changed drastically, and we were able to, I'll use a term earlier, weather the storm, and are able to make it through there and continue operations. Also, a concerted effort to expand our workforce to make sure we're retaining, promoting, and recruiting our exceptional talent. I'll talk a little bit more about what that means from a tactical perspective. And then a couple of other items. We're always looking to invest in technology, whether it's moving to cloud-based applications, whether it is ensuring that we have all the latest and greatest firewall, cybersecurity infrastructure in place. Chair Denham, as you mentioned earlier. And then certainly last but not least, and I'll talk a little more about this, is continue to advance our diversity, equity, and inclusion efforts. So before I talk about each of these strategies and give a couple of examples of each one, I'm going to stop here and ask if there's any questions about what these strategies mean before I move forward. Thank you.
Any members have any questions of John?
If not, I'm going
John?
to talk a little bit about the couple of accomplishments through the second quarter, 12/31/2022. And these are representative of various departments throughout the organization, one of which, loan servicing, 908 loans per employee. Jim Statler has set sort of a metric for the last several years to make sure we're right sizing loan servicing and servicing the number of loans per employee. And that was set at 800, and we have continued to ratchet that up and achieve that. It's 908 per employee. Jim mentioned single family in an area, single family, but the loan production volume we set out at the beginning of the fiscal year, this fiscal year, to have half a billion dollars of loan production, 500 million, and you can see we are just slightly over that at $270 million in loan production in the single family area. I'm not going to opine on the $2.9 million in secondary trade gains because Jim has mentioned that and talked through that in great detail. Certainly behind schedule from the 9 million that we had projected, but we've got some strategies to mitigate that. The tenant assistance, which stands the right-hand column, it says TAP, tenant assistance, that's what it stands for, program. That $281,844 in revenue may not seem significant, but that's revenue because we are starting to recoup and reinstitute and re-implement what are called MOR inspections in our project-based area and tenant-based area, project-based contract administration. And a lot of those were canceled due to COVID. So this is a good sign that we're able to generate some additional revenue. And this is a small part of the project-based contract administration where we get excess fees that are above and beyond our expenses, and that is attributable to and helps us to further our mission, not only in the tenant assistance programs, but other missional programs that we operate. So it's significant, and it really helps us to do the good work of the corporation. Housing Contract Administration is what HCA stands for. The 5,700 households served through homeless programs. And I'm going to just pause there for a second. And those are real households and real people through the first 6 months of the fiscal year that have received services in whether it's our emergency shelter programs, our HOPWA programs, the various programs that our Housing Contract Administration area oversees. And there are several of them, but that's real people, real households, real families. As in our multifamily programs, we've had over 900 units created or preserved. What you do not see on here is there will be another 712, I think 714 additional low-income housing tax credit projects that were just recently awarded. So that number will almost double by the end of the year here, which is right on track on what we've been wanting, what we said we were going to do. And so now some more of the qualitative items as it relates to strategy number 3. Specifically, our communication area, we have launched a blog and a podcast. Hopefully you have been receiving from Winston the information about those blogs and podcasts, as well as success stories via email that have come to you. But I will commend our communications area for looking and relaunching the podcast and blog with partners throughout the state. If you haven't had a chance, I would encourage you to listen to those or watch those. In our employee services area, the workforce minority representation is at 16%. When I started doing these presentations, that number was at about 12%. 11.5%, 12%. So that number continues to rise. I've shared a little bit about why that is. We've had an influx of temporary staff and been onboarding several people. Some of those folks have been permanent employees, and we will continue that effort and continue to further the workforce minority representation at the corporation. Also in employee services, we have designated a corporate trainer as well as a recruiter in our employee services area to do exactly what we are setting out to do, to recruit and retain and hire not only the best and brightest, but a diverse work force. So in our technology services area, I sort of alluded to this, and it was brought up a little earlier, but we have continued to stay up to date with our security enhancements, given the world we live in and the cybersecurity threats and the fraud and things of that nature. So whether it's new firewalls, whether it's penetration testing, things of that nature, our technology services department is implemented several new security enhancements and our cybersecurity area, as well as we are looking at and transitioning to a new co-location site. Our offices are here in Frankfort, Kentucky, but we operate right now out of Louisville, Kentucky, and we're looking at a couple of other alternative sites so that we have multiple redundancies, as well as adding circuits, additional circuits into the corporation so that we have multiple ways out and to various locations so that business never stops. Last couple of items, implementing new security systems and infrastructure, just making sure we're keeping the lights on. And one that I really wanted to end on and focus on, and I'm happy to take any questions, but the 40% of the available administrative fees realized, that's very important because, again, I mentioned as part of our strategy, specifically strategy 2, we want to utilize and make sure we are using and recouping all the administrative fees to pay for the programs that we operate. And we have a lot of different buckets, a lot of different grants, and a lot of different pieces and parts. And one of the areas that is responsible for tracking that, and you're going to hear from Mr. Vonderschmidt in just a second, is corporate planning and accountability, to make sure we're recouping all of those fees to pay for the services we deliver. In addition, corporate planning and accountability is responsible for the data of the corporation, specifically some of the publicly viewable data. And so this came into play we use a very powerful tool, and we have a dashboard that when in eastern and western Kentucky, when people needed units due to tornadoes or flooding, we've had thousands of people view available units real time on our website. So that's a great accomplishment, and that continues to be up and running as we speak and be used. And landlords and partners can add to that, and we keep it up to date. And then last thing I will say about our demographic data is the demographic data that we're looking at is not only related to minority workforce representation, it's really looking at our programmatic data and looking at the demographics of the population that the programs that we administer are intended and able to serve. So, for example, based on area median income, based on other criteria that the grant and the program is designed to serve. We want to make sure that, first off, we want to make sure we have an understanding of what the demographic of that individual program is. And then secondly, we want to begin to establish some metrics and be able to report and really provide some additional information. So with that, that concludes my portion. Before I turn it over to Kendrick, I'm happy to entertain any questions about our overarching strategies, about where we are through the second quarter, before Kendrick talks about all of the allocation and the way we deploy our resources through the second quarter.
John, just let me say that it's a job well done, and it's amazing to me, 908 loans per employee, 5,700 households through the homeless program. Those things are excellent work, and the board certainly appreciates your all's hard work. And Gail, do you want to make any comments in regard to John's presentation here?
other than they just do a tremendous job. I've never seen a staff work harder and be more diligent about the results than this. You all just are the best.
So I agree. So
Thank you for
John,
the
I'll pass
comments.
it
I'll
back
pass
to
them
you.
along. Thank you.
Okay. Thank you. Gail, you want to introduce Kendrick here?
I think, here we go, Kendrick.
Thank you, Gail. Good afternoon, everybody. My name is Kendrick Bonderschmidt. I'm the Managing Director of Corporate Planning and Accountability. Today, I have prepared for you a report on our allocations through the second quarter of fiscal year 2023. You can think of this as a report on how we have utilized the corporation's resources for programmatic purposes. But first, related to, for every one of these programs, we have either some grant income or some fee income that comes in the door. So our first page here is the grant and fee income through the second quarter. You'll notice that this is on a percentage basis. So what we projected at the beginning of the year is where this harsh black line on the right side of the page. But it gives you a sense of where we are, where we should be relative to Q2. The 50% mark is where we should be through Q2. And I will note that if you add all of these numbers up, we have collected $22.5 million on a goal of $47.5 million. That's 47%. We are right near 50%, which was where we would expect to be through Q2 on the money collected on our programs through grant admin and fee income. But if I were to highlight some outliers here on this graph, obviously this fourth line down, ESG, really sticks out as sticking across the entirety of the graph, and you can think of this as we have this is a grant program, so we have admin that is weighed against the expenses here. We do have sufficient admin to cover these expenses. While these expenses were not necessarily, we didn't expect to have this much expenses through Q2. We have plenty of admin to cover this, and we don't expect to overrun our available admin for this fiscal year. Other grant programs, you'll see things like Continuum of Care, our Home ARP, and HOPE, where those are lagging what we would expect to have collected through Q2. Those very much like our ESG program. Those programs, if we don't have expenses, we cannot collect against those collect admin against those expenses. So as Jim was referring to in a couple of places earlier, these are net and net fine for the corporation, zero for the corporation. We don't have expenses, we're not using the admin there. Finally, the bottom line number for this graph is, once again, 47%. We should be right at 50% through Q2. So the amount of grant and fee income collected through Q2 is proceeding as expected. We can move on to the next section. So now we're talking about the awards and the amount spent on programs through the second quarter. Very much program dollars that are either being awarded to our subrecipients or going out the door to our partners and in some cases directly to individuals. This is organized by program area. So at the top, these are our weatherization programs, making people's homes weather tight and things like that. This part of the corporation, we award those funds early on in the fiscal year, generally in Q1 or Q2. And as expected, we made those awards early on. You'll see line 3 with the bipartisan infrastructure legislation. That is up to $50 million that we will eventually get for this purpose. We are still waiting for the federal government to approve that plan. We've got a response in, and I think we expect that plan to be approved in Q3 of fiscal year 2023, at which point we'll start making awards against that. Moving on to the next section, that's the housing contract administration programs. You can think of that as our homelessness programs and our single family construction programs. And below that, the multifamily finance programs. I can handle these somewhat together. These programs largely, you see a lot of blanks here. We received funding for these programs through HUD, and those grants were awarded to KHC in January of 2023. And now we're turning around those funds to award to our subrecipients. So programs like ESG, HOPWA, and HOME, and NHTF, we received those funds from HUD, and we've awarded those in Q3. And then we actually mix those home dollars with our AHTF funds. So you'll start to see those in Q3, and ultimately they'll show up in our final report in August that we deliver to the board. You will notice that our tax-exempt bonding awards have come in a little bit faster than anticipated, but we still have plenty of multifamily bond cap for the remainder of the fiscal year. Moving down to single family programs, I will note that while our counseling dollars spent from the HAF fund have lagged, our counseling dollars from HUD are available. Those things do switch off. We don't generally pay for them from the same place at the same time. So those we are a little bit ahead on HUD, and that is causing us to be behind on HAF. And you will see our single family mortgage, as Jim has noted to you several times already, our mortgage production, very healthy, pretty close to where exactly we would expect at this time of the year. Finally, tenant assistance. I love tenant assistance. They always run like a metronome. They're right at 50% for the year. It's Q2, and they're exactly where they need to be for the fiscal year. Before I move on to our third and final page, is there any questions so far? All right. Finally, this is the allocations separated instead of by program area, by funding source. So we'll rehash a little bit here, but largely the same information from the previous slide. As I noted with the previous slide, we didn't receive our home funds until January, until Q3. So none of those awards are really reflected in Q1 and 2. And we do mix our AHTF funds with those home funds, which is also leading to why our AHTF section is empty as well, largely empty as well. We try to get the most bang for our buck out of those programmatically, and that's why we lace those two funding streams together. If we look at the bottom section of this chart, we'll see the Homeowner Assistance Fund. That's our internal funds that we have a little bit of leeway as to how we can use those funds. We use those funds for things like down payment assistance and for our counseling program. I will bring your attention to the bottom line here, which is our Targets of Opportunity program. Those are small grants that we give to our partners around the state. Generally helps them keep their operations going through the fiscal year, or they use the funds for special projects. We did exceed what we initially intended to award with these dollars through the year, and that is largely because we helped some of our Eastern and Western Kentucky partners with either tornado and flooding assistance separately. And then that was just about keeping continuity of operations for these partners and helping as many people as possible. And in the grand scheme of our HAF portfolio, that is not the largest section of our spending. So with that, I will once again open up for any questions about how we have allocated our funds through Q2.
Kendrick, thank you for an excellent presentation. Any members have any questions of Kendrick? Gail, you want to make any further comment?
No, the staff does a great job, and I think that's reflected in the reports that we get and follow on. So thanks, staff.
They
Thank
are
you,
top
Gail.
notch. There's no doubt about it.
Absolutely.
Well, Kendrick, thank you and John for your excellent reports. And Gail, thank you for chairing that committee and the excellent job you do chairing those committees. So if there are no further questions of the members, we'll move on. Thank you, Kendrick. All right, so we need to go to item 14, approval of the Public Housing Agency annual plan for rental assistance. Marty Shilcoat and Jonathan Coulter.
Yes, my name is Jonathan Coulter. I am the managing director of the tenant assistance programs. And first off, thank you everybody for being here today. Yes, we are seeking approval of our annual plan. The U.S. Department of Housing and Development requires us to get our agency's current programs and resident population has served, as well as our agency's strategies for addressing and meeting our local housing needs. In our annual plan, if you look at section A1, the tenant assistance program portfolio has increased to 6,438 vouchers from the previous 6,392, with the addition of 46 fair share vouchers. These vouchers are regular vouchers without special purpose requirements. However, HUD is encouraging but not requiring PHAs to use a preference to serve populations with these new vouchers. The populations preferred would be survivors of domestic violence, individuals or families who are homeless or as defined in section 103A of the McKinney-Vento Homeless Assistance Act, or a family that is at risk of being homeless. In section B3, on our progress report of the annual plan, again, KHC was awarded 46 fair share vouchers effective October 1st, 2022. KHC's made voucher offers to more than 2,500 waiting list applicants and increased overall program utilization. KHC has promoted landlord engagement on its website, webinars, and eGram to promote landlord participation for regular HCV and special purpose vouchers. And KHC's focus has been on increased utilization and special purpose vouchers. That's the overall gist of the annual plan. I'm open for any type of questions.
Any members have any questions of Jonathan here? Jonathan, we appreciate your hard work on these programs. You're part of a staff that do an excellent job, so we appreciate it.
Thank you very much.
If no members have any questions, I'll entertain a motion that we approve this annual plan. Someone, please.
I'll make the motions, Holly.
Thank you, Holly.
Second.
And we have a second? Okay.
Second.
We have a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. Thank you so much, Jonathan.
Thank you.
All right, moving right along to 15, approval to renew a personal service contract with Regulatory Solutions for quality control for $165,000. That's Kevin Field. Kevin?
Thank you, Mr. Chairman. Yes, agenda item number 15 is a request for authorization to renew a personal service contract with Regulatory Solutions, LLC for quality control or quality review services. So Kentucky Housing Corporation requires services to perform these quality control reviews in accordance with Fannie Mae, FHA, Rural Housing, RHS, and VA for both its single family mortgage lending side as well as its origination or loan production side. So following a request for proposals that was conducted back in February of 2022, Regulatory Solutions was selected by the review committee to provide these services, these quality control review services for KHC. As noted, as part of the review process, this committee decided that they best met the needs of the corporation based upon the proposed services, the overall qualifications, their relevant experiences and expertise, as well as the ability to perform the requested services. So with that said, I would be glad to answer any questions. KHC staff does recommend approval by the board of this resolution, but I'd be glad to answer any questions.
Any members have any questions of Kevin? This is a required situation where we have to have these services. So if there are no questions, I would entertain a motion to approve this personal service contract.
This is George. I'll move to approve the contract.
Thank you, George. Do I have a second?
Second.
Yeah, all right, we have a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. Kevin, thank you so much for your hard work and your effort here. We appreciate it.
Thank you.
All right, Lauren, you're up next, and you're going to talk about the appointment of a corporate secretary. And I just want to say, to begin with, we certainly appreciate your service in the interim here, and you've done a nice job, and we appreciate that. So I'll turn it over to you.
Thank you, Chairman. It was a pleasure to assist the corporation as interim general counsel and the corporate secretary. Sam Thorner was announced as our general counsel January 1st, 2023. So with that, to approve a resolution appointing Samuel Thorner as the corporate secretary effective March 1st, 2023.
Do any members have any questions of Lauren? Okay, if not, I'll entertain a motion that we approve this resolution.
It's Kathy, so moved.
Thank you, Kathy. Do I have a second?
Gail, second.
Okay, thank you. So I have a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. Okay, Lauren, with that, we have to update the signatory authority for the corporation. So would you discuss that with us?
Yes, so previously this board has authorized the executive team and deputy executive directors to have signatory authority to conduct the business of the corporation on its behalf. With Sam now being named as general counsel and corporate secretary effective March 1st, 2023, his signatory authority is needed to be updated to reflect that authority he will now have to sign these documents on behalf of the corporation's daily business. So staff recommends approval of a resolution to remove myself, Lauren Van Sickle, as interim general counsel and to add Sam Thorner as general counsel.
Lauren, you're going to stay as deputy general counsel, is that correct?
Yes.
Okay. All right, do any members have any questions of Lauren? If not, I'll entertain a motion that we adopt this resolution.
This is George. I'll so move.
Thank you, George. Do I have a second?
Second.
Okay, we have a motion and a second. All in favor signify by saying aye.
Aye.
Motion carries. Okay, thank you, Lauren, so very much. We appreciate you.
Thank you.
So, Winston, I'm going to turn this informational item section over to you. I know you have some comments you want to make, and I'll let you introduce Wendy and Kenzie. So,
sure. Thank you very much, Mike, and all the members that are here. We've got two items listed as informational items on the agenda, and we're going to do both of those, and then those are going to be followed by one additional informational item, which I'll give, which will be a fairly brief update on developments in Western Kentucky and Eastern Kentucky as a outgrowth of the disasters that we've experienced there, and some of the involvement that the Kentucky Housing Corporation has had and what's going on there and what may be going on there in the future. But the first report is an update by Wendy on the HHERF ERA number 2, and of course that's the rental assistance program. And without further ado, I'm going to turn this over to Wendy. And we started this rental assistance business over 2 years ago, and Wendy and her team has done an excellent job. But with all good things, they change over time, and with the change in funding. But Wendy?
Thanks, Winston. Good afternoon, Mike and the rest of the board. So I am here to kind of give you, it's not the final report, but it is getting pretty close to being a wrap-up report on the Healthy at Home Eviction Relief Program itself, which was a pandemic rent assistance program. And I just want to give you all a kind of the highlights, the key takeaways, and what I'd want the board to know about that program, since we are in the process of winding it down. So just to remind you or tell you for the first time ever, if you haven't seen this stuff before, we received during the pandemic 2 large buckets of emergency rental assistance funding from the U.S. Treasury. And actually the funds went to the finance cabinet and then were subgranted to KHC. And this is, so we call it ERA 1 and 2, emergency rent assistance. It came through 2 different buckets of legislation in late 2020 and then in March of 21. And so the Commonwealth of Kentucky got funds, but also Louisville and Lexington got these funds. And the aim of the money was to prevent evictions during the pandemic, to keep people housed during the pandemic when many folks were losing income, losing their jobs altogether, or having higher household costs, hospitalization costs. And we just didn't want to see people, lose their housing, particularly during a pandemic when having a place to call home, it's always important. It was just essential during the pandemic. So we served, for the most part, 118 counties, so everywhere but Louisville and Lexington. For a short time, we did serve Jefferson County. I'll talk about that in a minute. And you can see it's an enormous amount of money, $264 million in the first bucket, $232 million in the second bucket. What's valuable for you all to see is that we redirected significant amounts of the state's dollars to Louisville and Lexington to keep their local programs going, or in some cases, in order to keep Treasury from sweeping the funds back to the federal pool and to keep the money in Kentucky. So you can see significant portions, and I'll show another version of this, were redirected to our partner grantees, Louisville and Lexington, because for the most part, we did not operate in those 2 jurisdictions. Next slide. So in Kentucky, our primary rent assistance program, and really the only one we've had until just a few months ago, was Healthy at Home Eviction Relief. You all have heard me talk about this many times. The governor talked about it quite a bit in many of his updates during the pandemic. So we launched in February of 2021, along with Louisville and Lexington. We were one of the first states to launch, to get an online application up and running and start taking applications. So over the last 2 years, we have paid out $244.9 million. We have never done anything like that before. 222 roughly was rent assistance and 25 was utility assistance. We do have $2 million in returns, and I can't tell you what it's too hard to account for exactly what that's attributed to, but that just to be transparent with you all, about $2 million was funds that came back because they didn't cash the check or they gave a wrong bank account or what have you. When you look at this in terms of how many payments we got out, it was over 76,000 individual payments for these different costs. And we helped over 56,500 households across Kentucky. The average assistance per household was relatively low compared to other states, at $4,300 per household, all in assistance. Next slide, please. Significant portions of our assistance were really kind of weighted towards low-income households, which was the intention, but we were allowed to serve a really broad range of incomes, up to 80% of area median income. But 66% of our dollars went to households that earn less than 30% of area median income for where they live. Another 23% of who got our funds were in what we would still call low income, but not that lowest income bracket. They're households that earn between 30% of area median income and 50% of area median income. So we're really pleased about that. You add that together, and that's 89% of the funds going to low income Kentuckians. 31% of all the funds we paid out went to households of color in Kentucky. These are households that self-identified as being Black, Hispanic, or multiracial households. So again, that was a goal, was to make sure we're serving folks most impacted by some of the instability brought on by the pandemic. Next slide, please. So if there's one takeaway I want the board to get, it is that Kentucky, Louisville, and Lexington, we did prevent a tsunami of pandemic evictions. You all might remember early in the pandemic, there was this worry that just, tens of thousands of people across Kentucky might lose their housing. I will say at KHC, we were equally worried that we would lose landlords, because some of the most important affordable housing in Kentucky are mom and pop landlords that might not get any subsidy from us, or maybe they take a voucher, but if they don't get their rent payments for 3, 6, 9 months, they can't keep going. They might send those units into foreclosure, or their own household stability would be threatened. So this really was a program that helped tenants, landlords, and utilities. And I want to underline that while most folks think of the tenants, we really spent most of our money went directly to landlords and utilities. A very tiny amount went directly to tenants. Next slide, please. Okay, so this is going to be hard to see, and I won't spend a ton of time on it. This is a chart that we got from the Administrative Office of the Courts that is showing forcible detainer cases that met their final disposition, meaning a case came to the courts and someone got evicted. And what you can see is that the orange line is pre-pandemic. The orange line is 2019. The red line is 2020. You will see that bottomed out, right? Because there was a moratorium. There were no evictions. The courts were closed. Nothing happened for a while. Now, the eviction moratorium was only on cases that were for non-payment of rent. So if you were being evicted because you broke the lease, you could still be evicted during the pandemic. And we did start to see later in 2020, some evictions did come back and did happen, but still at a way lower rate. And then you get to 2021, that's the blue line, that still remains much lower. Now, what we saw in 2022 was eviction rates started going back up closer to pre-pandemic. But to me, what this says is, we know there was not a tsunami of evictions, and this assistance has still kept the rates relatively lower than they were before the pandemic. Next slide, please. One of the things we are really proud of is we collaborated very closely with Louisville and Lexington. The three of us met from the very beginning to make sure our programs were almost identical in benefit profile, troubleshooted problems. We met together with Treasury at different times. We all opened and closed our programs at roughly the same time, not same dates, but roughly the same time. We used some of the same program documents because a lot of our landlords are in all three of our jurisdictions. We wanted it to seem very consistent. We at KHC really optimized the grant funds by reallocating them to Louisville and Lexington to keep their programs going and keep money in Kentucky. We also, all three, recently met with the courts, with the Administrative Office of the Courts, to request some changes to the forms by which evictions are filed that would help our court diversion programs. So it's just a really good partnership. Next slide, please. And this partnership is demonstrated in part by this reallocation of funds from Kentucky's coffers to Jefferson County and Fayette County. So the first column is what everyone was originally allocated by Treasury. And then if you look at the second column where it says final allocations, that's what the shakeout was once funds were reallocated from our coffers to Louisville and Lexington. So you can see a significant amount we more than doubled their funding with dollars from our grant, just demonstrating that partnership. All three of us have a court-based eviction diversion program. Of course, Louisville and Lexington, they have one court, one set of staff for that court. We are currently active in 5 courts and like semi-active in about 4 more. And we're looking to figure out how we grow and keep that going with the funds that we have remaining. It's been a really good partnership. So under effective practices, working with the courts has been great. That's a brand new relationship that we never had before this program. We ramped up and streamlined an online application with electronic signatures and really fast processing. We adopted almost any flexibility Treasury would give us, including something called a fact-specific proxy, which allowed us to use like incomes in a zip code to determine if folks were eligible. We brought on and ramped up and trained over 100 staff. We used a vendor to add to that capacity, and we implemented a lot of anti-fraud measures to try to reduce any fraudulent applications and flag potentially fraudulent applications. And I want to make sure that the board knows Kentucky was viewed as a leader in this program. We were interviewed and still are getting interviewed by the National Low Income Housing Coalition, Treasury, HUD, the Government Accountability Office, in order to learn from our program and some of our best practices. In fact, the National Low Income Housing Coalition produced a report that named Kentucky as a champion of innovation and said that a lot of our work allowed other grantees to take the leaps with some of the Treasury flexibilities that they might not have done otherwise. Next slide, please. And so we are in the process of winding down the program. We served Jefferson County from May to December of last year. We have stopped serving Jefferson County because we sent them an extra $38 million. We have stopped accepting new Healthy at Home eviction relief applications. That happened in January. We are still processing the existing applications that are in our queue, but are no longer taking new applications. We do have funds left. And so with the funds that remain, we are doing a limited set of long-term activities. We are funding legal aid services across the state for at-risk renters. We are keeping our eviction diversion program going. So we will still have staff working with the courts, and we will help people with modest amounts of rent assistance who are facing eviction or with a relocation voucher. We have a team of housing connectors that are helping people get located into housing, get leased up, utilizing our Section 8 vouchers. And we are working with our homeless providers across our continuum of care to do prevention and diversion with these funds, where they will, again, help people get leased up or stay leased up. But again, a much narrower range of households and a much narrower amount of assistance because we just, we've got limited funds. And that's it. I welcome any questions anyone has.
Does anyone have questions of Wendy?
Just let me make a comment.
I do not have a question, but I have a comment for Wendy. I own rental property, Wendy, and 3 of my tenants over the last 6 to 8 months have gone through that program, that Safe at Home or whatever it's called.
Yeah.
Just very smooth. The website's very easy for both sides. So I just wanted to give you those props.
Glad to hear that.
Winston, just let me make a comment. I just want to say the work that Wendy and her staff have done is absolutely amazing. And Wendy, we really appreciate it. The Commonwealth owes you a debt of gratitude for your work. And we appreciate you so much that you've been a national leader with this program. So thank you.
My pleasure. Thanks so much.
I'll just add, it's not easy to start up a brand new program and to dispense these sorts of funds to so many individuals and to hire the staff and train a contractor and do all these things. And Wendy and the people who worked with her, including Jonathan Coulter, who I think is still on the call, who's been the primary person working with Wendy to head up this program, have done a phenomenal job. And I know you all are always very kind and very complimentary of our staff, and we appreciate it, and we hope we're deserving, at least most of the time. But in this instance, there really has been an extraordinary effort, and people have made a lot of personal sacrifices to make it happen. And I'm very appreciative, and it will not be forgotten. With that being said, I'd like to move on to Kenzie Struvack. And Kenzie is let's see what our appropriate title is, Assistant Director for Homeless Programs in the Housing Contract Administration. And Kenzie is in essence in charge of our homeless programs, and that's also referred to in part in some cases as the continuum of care. And this is a part of our organization that's been around for a while and has done a lot of good work, but by and large has been limited by the funding that we've received from the federal government in years pre-COVID. And when COVID came along, we received some substantial additional funding, which Kenzie and her team have been able to put to good uses to aid the assistance of the homeless folks. And then as we are in the process of presumably coming out of the end of COVID, there's been some additional funding that's been made available to homeless programs around the United States. And Kenzie and her group have submitted an application, a competitive application to the folks in Washington, and have come out a very substantial winner with an allocation of funding disproportionate to our size of a state and otherwise, based upon the merits of the type of programming that we've been offering and that we plan to continue to offer. Now, I hope I didn't say too much wrong, Kenzie. And
you did great.
Your introduction, but we wanted to take a little bit of time and tell you all a little bit more about our homeless programs, from what all they do, who all they involve, and what we have planned for the future. Kenzie?
Thank you so much, Winston. Thank you for having me today. I am so grateful to have the opportunity to talk with you about KHC's role in addressing and ending homelessness in the state of Kentucky. It is certainly my passion and the passion of my team. Having said that, as you may imagine, ending homelessness is quite the complex and daunting task. And likewise, so is trying to present on all of those efforts in a meaningful way in the span of a couple of minutes. So I'm going to walk through this as fast as I can. I don't want to keep anyone too late. And obviously, I'll have time for y'all to ask questions at the end. So today, I'll briefly go over KHC's role and strategies for our homeless response system, as well as the programs that we operate. I will talk about the Kentucky Balance of State Continuum of Care, as Winston noted in his introduction. We'll talk about pandemic efforts, the various funds that have come specifically to address homelessness that we've been working with, as well as that supplemental notice of funding availability, which was targeted for unsheltered and rural homelessness. Okay, so today I'm really going to focus on the programs that are federally targeted to end homelessness. There are two programs that are federally awarded through HUD that come to KHC, and then we do our due diligence to allocate them appropriately and get them out the door, deploy those funds to our homeless program partners around the state. So we have our annual formula grants that we get. We also receive competitive grants from HUD, which I'll talk about in a little bit more detail at the end. So the Emergency Solutions Grant Program, if you were following along with everything Kendrick was updating, you've seen these titles of funding sources before. We've got our ESG program, the Continuum of Care, or COC program. We also get some specialized rental programs. The Home Tenant-Based Rental Assistance Program is one of them, as well as HOPWA, stands for Housing Opportunities with Persons with AIDS. We also have some awesome partnerships going on at KHC right now within our HCV department, utilizing emergency housing vouchers and our mainstream voucher program. And then we also at KHC are the designated Kentucky Balance of State Continuum of Care Collaborative Applicant and Planning Entity. And I will talk a little bit more about that in a moment. So what do we do in a nutshell? This is as watered down as I could get it to try and fit on a slide. It is certainly much more complex than this. But in essence, my team, KHC, we are responsible for overall system planning and oversight if you're looking at the homeless response system. So we use the planning for creating, overseeing, and evaluating the Kentucky Balance of State homeless response system. We also do a lot of allocation planning. As you can imagine, we're working with a lot of grants. So we're tasked with strategic funding, decision power with our HUD annual formula grants, which would be HOME, HOPWA, and ESG. And then we are also the collaborative applicant, as I mentioned, for the Continuum of Care in the Balance of State, Kentucky. And under that umbrella, we do a lot of really, really big things. We coordinate and submit the annual COC application, which is a month-long process, like 3 months long, 4 months long process. We also coordinate and submit data to HUD for the annual point in time count, or the K count, as you've heard of it here in the Balance of State. And then we work in tandem with ourselves, the ESG recipient for the state, KHC. So I know there's a lot of words on this, and I will go through it very quickly. I just wanted you all to have, for your own reference later, should you ever be interested, with these two main federal programs that are designed to end homelessness. What are the different components or activities that these big programs do? So the Emergency Solutions Grant Program, it's a formula-funded program. It provides funding to operate and staff and provide services in an emergency shelter. It provides funding to do street outreach. That's where people go outside and they are working with vulnerable people living unsheltered or in places not meant for human habitation, in the hopes of connecting them to life-saving services, whether it be emergency shelter or medical care, and also getting them into a permanent housing. Rapid rehousing is a permanent housing program that provides intensive services as well as short to medium term rental tenant-based rental assistance in the community. And then homelessness prevention. That's a very small component that's there to help keep people where they are. So annually, KHC gets about 2.5 million. And just for context, we have to make really tough decisions with this funding every year. Our credit committee is amazing for listening to me rattle on about it and why the decisions are the way that they are. And that 2.5 million goes very quickly, as you might imagine. We fund anywhere from 32 to 36 organizations and shelters throughout the state, with the hope of having as best as possible geographic coverage. And so that money gets eaten up quickly. And then we have our COC program. That is a very competitive program where we're serving in a couple of different roles as the collaborative applicant, the largest recipient in the Balance of State as well, and the HMIS organizational lead for the state. That program offers also rapid rehousing, permanent supportive housing, which is an indefinite housing subsidy paired with intensive housing focused supportive services wraparound in the home. Those are for people who really have no other choice. They have no other chance. They have burned bridges. They are the hardest to serve. These are our chronically homeless community members who have mental health concerns, substance use disorder, and really do need those wraparound intensive services. There's also supportive services attached to the COC program as well. So those are our main programs. And then the Kentucky Balance of State, which I'll go into more detail in a little while, but we serve as both the ESG recipient and also the collaborative applicant for the Balance of State. In addition to that, we also serve as the HMIS lead for the state of Kentucky. We work with all the continuums of care in that role. But our goal, our job as the KY Balance of State is to fund, serve, and coordinate homeless response system activities and interventions across 118 of our 120 counties. Next slide, please. So Winston wanted me to talk with you all today about some of the strategies that we've been using in my team, not even just in my team, but across KHC as a whole. While the pandemic has been truly difficult, it has also given us at Kentucky Housing Corporation a lot of opportunity to connect the dots. And so with the help of our fearless leader, Wendy, who is all about connecting the dots, we've been able to do some really cool things that I'm excited to tell you about. So our main core strategies for homeless programs is to have a strategic application and funding decision process to try to create full 118 county coverage, which is very difficult at times. With our Housing Choice Voucher Program, we've expanded our service footprint for mainstream and emergency housing vouchers to serve the full 118 counties that the balance of state serves, which is amazing. With our treasury funds from ERA2, as Wendy said, we've got some innovative homeless programs that will continue our pandemic era system capacity momentum. And then in the development world, investment in rental developments with true fidelity to supportive housing and supportive housing best practices. Next slide, please. So what does all that mean? So connecting the dots, what our strategies have been is to ensure service intervention coverage and identify gaps around the state. We spend a ton of time staring at maps of the state and trying to pinpoint where we need to try to plug in our resources. What's been huge as well, and what will continue on and has been so successful, is interdepartmental collaboration and partnership. We've seen some amazing success and strides over the past several years with partnering with ourselves. In all of our system planning and design that we do is really leading with inclusivity and racial equity in mind, and also in partnership with those who have lived expertise, so those who have had experiences of homelessness. And then to develop innovative solutions to ending homelessness. And like the federal government, we at KHC, we've been working on utilizing a whole of KHC approach, right, to addressing and ending homelessness. So really maximizing our resources as the organization that we are. And then lastly, to invest in ongoing expert homelessness services, training and technical assistance, both for us as well as for the partners of the continuum of care and the agencies that we fund. Next slide, please. Okay, so I'm going to go through all of this very quickly, and I apologize, but you do have the slides there. Like I said, if you are interested later on. So in the state of Kentucky, we have 3 separate continuums of care. We have the Lexington, Fayette County continuum of care, the Jefferson, Louisville continuum of care, and then the balance of state. So like I mentioned earlier, we are in charge of 118 counties here at Kentucky Housing Corporation. So what is a COC? Confusing because it's a program, but it is also a comprehensive geographic system and planning body that's dedicated to ending homelessness. So basically that means a continuum of care creates a network of providers and key stakeholders. It's got its own governing and planning body specifically for the homeless response system. Our partners in the continuum of care are HUD funded and non-HUD funded homeless service providers, faith-based organizations, shelters, victim service providers. So anyone who's doing domestic violence work, community mental health providers, the healthcare sector, community action organizations, and then service organizations that have the overall goal of creating a response system whereby homelessness is rare, brief, and non-recurring. And I'm not going to go through this, but here is how our continuum of care is organized and governed. So we do have a board separate of KHC that my team works with to come up with all of the funding policies, priorities, and how we're going to systematically end homelessness in the state. Next slide, please. So I have a slide on here about coordinated entry, and really just to say that it is, like I said, it's daunting to address and effectively end homelessness. So one of the things that continuums of care are required to do per HUD is to come up with a universal triage system. So coordinated entry is the term for that. It's a system-wide process that's designed to assess, triage, and then refer people to experiencing homelessness to the very limited housing resources that we have in the state. So the coordinated entry system in a nutshell operates much like an emergency room waiting room in that it triages, prioritizes the most vulnerable households, vulnerable to death, vulnerable to infectious disease, and get them prioritized and referred to those housing resources. Because our COC is so big, we have to do a lot of planning locally. So I put this map in here just so you all could see. We and my team for the balance of state have to coordinate with not only 118 counties, but that is broken up into 15 different regions. And I imagine you are all from different corners of the state. And so you know how very different it is to try to apply things that might make sense in Western Kentucky to Eastern Kentucky. So I just wanted to give you a visual of what we're working with when we're coordinating daily. Next slide. And then I wanted to highlight a core principle of all HUD homeless programs, which is housing first. And I'm hopeful some of you have heard of this term before. It is a principle and a methodology to service delivery and to housing standards for our programs, our rental programs. So it's mandated by HUD. It removes programmatic barriers to entry, doesn't mandate participation in services, doesn't require people to be sober in order to have housing or to be enrolled into some sort of mental health care program. It also establishes that shelter is not the end to homelessness. It's just the first step in the system, right, to get you to your permanent location, which would be permanent housing. And it actually turns out to be exponentially cheaper to remove those barriers, get people into housing off the street, out of our systems of care, and provide a rental subsidy than it is to allow them to continue to be in our systems of care, the criminal justice system, the healthcare system, or emergency services system. Or out on the street. It's much cheaper. I'm going to talk very briefly about the programs that our department received and then also that we worked on collaboratively with other departments during COVID-19. So we, before the pandemic, as you might imagine, and as Winston said, we did not have nearly enough funding to meet all the needs of all of our partners around the state. I've given some examples here, but I don't feel like I need to go through them all for an effort of time. So next slide, please. So the pandemic presented a lot of opportunity for us. So we received $24 million approximately in emergency solutions grant funding through the CARES Act. With that, for the first time ever, we were able to have 100% rapid rehousing coverage in all 118 counties of the balance of state. That's never happened before. It was amazing. So we were able to really fund these interventions that are proven to work to end homelessness to scale and really ramp up capacity and fill some serious gaps around the state. Next slide, please. We've been partnering with the HCV department on the emergency housing voucher program. Those are specialized housing choice vouchers specifically for those experiencing homelessness. So the total of EHVs that we have added to our menu of interventions in the balance of state is 377, and that was a true gift. Absolutely. Next slide, please. I'm not going to go into too much detail about this either because Wendy covered what we're doing with ERA2. I will point out that KHC Housing Connector team that Wendy mentioned in her presentation launched last year, a year ago. And since then, we have been able to assist, that team's been able to assist 121 homeless individuals and families successfully lease up in an EHV assisted unit. And I want that to sink in because that is a huge feat. For us, it's involved a lot of different teams working together from various departments, and it's truly proven to be a worthwhile investment of ERA2 funding. Next slide. And then, of course, there's the Home American Rescue Plan Act allocation. So KHC was allocated $52 million in home funding on top of our annual home funding. This funding source is specific to addressing and ending homelessness. So development of affordable housing, supportive services, which under the normal home program does not allow, and then acquisition and development of non-congregate shelters. And through those efforts, through that funding source, we were able to engage with the Corporation for Supportive Housing, which I believe you all have heard presentations on in the past. As a consultant to help us figure out what is the best way that we can meet the needs of the continuum of care, build affordable housing that will serve high need and vulnerable households, and then help us, really address the housing, the insufficient housing stock that we have around our very rural continuum of care. Okay, so this is my big exciting news. So the special supplemental notice of funding availability that was, or for funding opportunity, sorry, was released in the fall of 2022. It is a first of its kind continuum of care fund package to address specifically unsheltered homelessness and rural homelessness. So the intent was to allow funding opportunities for communities to better coordinate their approaches that are grounded in housing first, leveraging housing resources, affordable housing resources, and also hinging on the public health principles to reduce unsheltered homelessness, improve services, health outcomes, and housing stability among the most vulnerable unsheltered individuals and families. It was an incredibly competitive, multi-pronged application process that just so happened to be going on simultaneously with our annual continuum of care application process. Both applications take anywhere from 3 to 4 months to do. So to do two at one time was pretty wild, but we did it. Next slide, please. So of the we, Kentucky Balance of State, did incredibly well in this application. Not only did we submit 26 project level applications for our partners, but we submitted a very taxing 15-page plan on how we have and will continue to work to address unsheltered homelessness and ultimately end it. And I say tasking because 15 pages sounds like a lot. It's not. I already recognize how long this presentation has gone. So imagine trying to cram everything into 15 pages of all the work of a state over the past several years. So we've received $4.8 million in new continuum of care program funds. Next slide, please. What does that mean? We actually received the 11th highest award across all states in the country. Little rural Kentucky, 11th highest award. We also received the second highest award for the rural pot of funding that was part of the application. Next slide, please. So you can see here, you can see how other states did. If you're looking at like California, let's think about that. High prevalence of unsheltered homelessness, which is in part a lot of how these how this competition was scored, was your rate of unsheltered homelessness. It makes sense that they would get 23%, but for us to be 11th as a state, I think speaks volumes to the work we've been able to do, both as the Balance of State, as KHC, in the work of our homeless service providers around the state. Next slide, please. So with this new funding opportunity, we've got some really big things happening. We have 5 new street outreach programs that will be funded, and those will be in areas where we have never had street outreach before, if not for pandemic era funding. This is huge. These are all renewable, hopefully, projects after their initial 3-year term. And then 3 new permanent supportive housing programs, which we desperately need across the country, but certainly here in Kentucky. And then we secured funding to continue on the Housing Connector team beyond those ERA $2. So we're excited that we've been able to demonstrate to HUD that we are doing some innovative and effective things. And I think, because of all the different funding sources that we were able to work with through the pandemic, we were ready. Taking this regional approach of filling gaps and working across different departments, we were ready the moment this funding opportunity was announced to really hit the ground running. So we are very excited. We competed better than almost every single one of our Balance of State peers around the country. And I'm happy to take any questions.
Kenzie, let me make a comment. Thank you for your outstanding work. And I noted that you all were the first to have your plan approved in January of 2022.
For our home, yes, yes.
And, I mean, so thank you for being a national leader. I do have one question. Outside of, in the rural Kentucky, outside of, I'm sure Eastern Kentucky has probably the most homeless because of the floods right now, but, and maybe Northern Kentucky is next. But outside of those two regions, where's the worst homeless problem? I noticed, and the reason I asked that, Western Kentucky was shown as a on one of your slides as a desert area.
Yes.
And is that because they don't have the homeless problem, or are there other reasons they don't receive that money?
So the desert part of that is, in order for us to identify people experiencing homelessness, we have to have service providers and partner agencies there to do that work. So when I talked about how exciting it is to have 5 new street outreach programs, for example, in areas where we have not had those services before, that speaks to, we need people to do the work there so that we know what the actual prevalence of homelessness is. So Western Kentucky, for example, we have some very strong partners in Western Kentucky, but they are more focused on specialized populations. So survivors of domestic violence or people living with AIDS or HIV. We have very few general homeless service provider organizations in Western Kentucky. So a part of what my team does is we work alongside of our leadership, right, to go and speak to communities and help them kind of navigate, like, you think you have a homelessness problem, how can we help you? And try to get them into our membership at the Balance of State COC so that they can then someday compete for funding and address those needs. So it really just depends on the area, like you mentioned, from Eastern Kentucky to Western Kentucky, and then also what the stakeholder what the stakeholder presence is and what services are already being offered.
Well, just let me say your work up has made a big difference up here in northeastern Kentucky, and we appreciate it.
Oh, I am really there's been some amazing things that we've done with this opportunity, and I'm pleased to say, like, areas like Maysville, the Buffalo Trace area, where we never had fully region-wide general homeless services. I'm so happy to have that. Same in the Lake Cumberland area. Like, we've really been able to fill some gaps and create some lasting capacity around the state, I think.
And this is Kathy. I am so impressed at what you guys have done. And yet I see today that evictions are going to be back up, although the amount we spent per household to keep people housed is like relatively peanuts. And as you say, people being homeless is incredibly costly. So what?
I know.
Bless your heart. That's all I gotta say. Thank you so much. And I'm sorry we have such incompetent legislators that can't think of anything to do with tax money that would keep people in their homes.
Though, we had the opportunity with the pandemic funding, right, and the different relief acts to rise to that occasion and, have some teeth to the things that we have been like, give us more. And I'm really proud to say that our COC in our state, we did that. There are some states who
really
did not. So
you were brilliant, as was
we couldn't do it without our partners. Yeah.
The rental assistance and the homeless, brilliant, and proven that we can keep people in homes, that we can put people in homes, that we can lower costs and all these other burden systems, and we turn our back on it. I am so glad you worked so hard for at least this to happen. Thank you. Thank you.
Thank you.
Kenzie, thank you very, very much. I don't know whether there are any other comments or questions. I don't want to cut off any comments or questions that anybody has. Our meeting has gone longer today for good reasons, because we got good things to cover. But it's now 4:15, and I don't want to prolong this meeting much longer. I'm going to just say a few things about Western Kentucky and Eastern Kentucky because I said I would. But I'm going to keep them brief. And if you got questions, you can call me, and we can cover this more exhaustively in the meeting that we have upcoming in April. But as you know, with disasters, particularly disasters that destroy or seriously damage housing, you have long-term effects, and you have a long-term recovery period. And it makes it extremely difficult and extremely excruciating upon all the people that who've suffered in that process. What's going on in Western Kentucky and what's going on in Eastern Kentucky is no different than that. It's no different than what's happened with the tornadoes in Kansas, and what's happened with the flooding in hurricanes in Florida and South Carolina and other places. But it is a difficult process to be involved in, particularly when you're in the housing aspect of it, because housing is so slow to get recovery going. And the programs that exist are the programs either are non-existent, or the programs are so slow in the way they move, it makes it difficult to get any sort of quick response. And even if you had a program in place, for quick response, I mean, the resources that are necessary to build or to repair, and the manpower that it takes to build and repair, is very difficult to accumulate and organize and get in a position to do great things quickly. From Kentucky Housing standpoint, I mean, we are not a disaster response agency by the very nature of what we are. We're a housing finance agency, and we don't have resources that have been previously allocated to us to be prepared to step in and finance or otherwise make recovery come about that quickly. But we were there on day one in Western Kentucky. Wendy was at the command center the morning after the hurricanes went through, and not the tornadoes went through, pardon me. And we've tried to be responsive and supportive all the way through. And we have in many, many ways contributed, including the accumulation of a directory, essentially an online directory of all available housing that might serve as alternative housing for people in West Kentucky following the West Kentucky tornadoes, and that we did the same thing in East Kentucky following the East Kentucky flooding. That required a lot of work by the people that work with Wendy and the partnership. That this is not the stuff they normally do. This is not the stuff that the information they normally accumulate. They have other duties and jobs that they have assigned to us at Kentucky Housing, but they jumped in and undertook them and did a great job of doing that. We've been Kentucky Housing Corporation, principally through Wendy and myself, have been able to monitor and be involved in what's been going on in the recovery effort more in the last 6 months than in the first 6 months of all this. But we've been certainly there in a lot of at a lot of the meetings, not all of the meetings, to learn what's going on and what the future holds. With reference to West Kentucky, two big things that you need to be aware of is that three counties in Western Kentucky and Breathitt County in Eastern Kentucky were declared disaster areas as a result of the tornadoes and flooding that occurred in 2021. And those four counties are essentially being grouped together and handled together for the purposes of the community block grant or community development block grant disaster relief funding. And that's funding that comes from HUD, and at least 75 million plus some has been set aside or earmarked for those four counties and the efforts that are in rebuilding that are going to go on there. And that's not exclusively for housing. Some of that is for housing, and others is for infrastructure and other activities. As Dennis knows, Dennis Keene, who's on with us, the Department of Local Government is charged with the interacting with HUD and the development of an action plan and the submission of an action plan, and then working with others to execute on the action plan for particularly for what I'm talking about now, West Kentucky. And they've been very actively engaged in doing that, responding and developing plans for disaster funds is very different than doing that for regular community development block grant funding. The rules are different. And we've been pursuing the knowledge of what we need to do to be able to be effective in utilizing those funds. And in fact, we're attending an all-week, 5 of us from housing are attending an all-week seminar in Berea that's being sponsored by FAHI, but is being put on by SBP, which is a consulting firm that has worked in disaster relief funding for disasters around the country for the last 15 or 20 years. And we hope to work and to learn along with representatives of Dennis, the Department of Local Government. I know you all are going to have some folks down there. The Public Protection Cabinet is hopefully going to have some folks down there. And all of us collectively can learn what we can best do with the dollars that we have available in those block grants, disaster relief for Western Kentucky, and what will be forthcoming for Eastern Kentucky. But that's still a work in progress, and there's hope that by within a few months, there will be some more specific proposals out there on the streets, some NOFAs out there on the street to where we can combine disaster relief dollars with other resources that we have, in particular the bond cap, to where we can create some funding to create housing in the 4 counties that were affected by in 2021. In addition to that, you should just know that while we're not directly involved in this, through the governor's fundraising efforts with the Western Kentucky Team Kentucky funding recovery effort, a lot of money was raised for the recovery effort there, and the Public Protection Cabinet has sort of been charged with being the carekeeper of that and helping in the implementation of what can be done with those folks. And at least 16 million of that have been set aside to build 300 units of housing in West Kentucky. And that's working with the Habitat and other organizations similar to that. And so within the next couple of years, there should be at least 300 new housing units standing as a result of those dollars and the efforts of those charitable, those organizations. There are 35 of those, 37, pardon me, of those units occupied presently, people living in them that didn't have a place to live before. There's 22 under construction. And as you can see by doing the math, there's still a lot to be built there. But it's my understanding that those are going to be underway and will ultimately, and when combined with the other resources that the disaster relief funding will provide, plus some other things that are being worked on may provide, then we hopefully will be able to provide some significant relief to the people of West Kentucky. In terms of East Kentucky, it's an entirely different type situation because you can rebuild in the path of a tornado where a path of a tornado was. You can't rebuild where you're in the floodplain. And so much of the housing that was destroyed and seriously damaged in East Kentucky was in the floodplain. And so in order to rebuild housing in East Kentucky, we've got to relocate people to higher, safer ground. And the governor has taken the leadership in directing the cabinet to pursue locating and identifying places that are higher and safe above ground, that above the floodplain, that housing units can be constructed on. And thus far, you all probably all followed this in the press, but there have been 2 sites that have been located and identified, and to where housing will be started to be constructed there as soon as the infrastructure can be created to get there. And these are basically strip mines that have been left, but they don't have roads to them. They don't have utilities to them. They don't have the things that you need to have before you can start to build housing. But that process is underway. The state is committed to developing those 2 sites. They hope to locate at least 2, maybe 3 or more additional sites to do those sorts of things on. And that's, the state is very much engaged in doing that and making a space for this housing to be built. In addition to that, out of the East Kentucky team, Kentucky Fund, the governor and the public protection cabinet have committed $600,000 to start building on 8 houses that are going to be built. They're not going to be built on those sites, but upon alternative sites where that they can be found that they can start building on, that are not dependent upon having the new infrastructure built. I'm going to a dedication on Monday in Whitesburg of one of the first ones for the process for the building to be completed, and that's all pretty exciting stuff. There are other efforts afoot to provide additional funding for Eastern Kentucky housing redevelopment, and of course, money is a subject of the control of the legislature, and obviously it has to involve the legislative direction and cooperation with the governor and others. And all I can say about that is, and I'm not actually inside the tent on what's going on there, but there's efforts ongoing on behalf of everybody to find find funds for quicker housing solutions than can be provided by ultimately the community block grant development DR money that will ultimately come to Eastern Kentucky. There's a lot more I could say. I meant to be briefer than what I've been, but I'm happy to answer any quick questions, or I'm happy to take your calls at a later point in time if you don't want to ask the questions now.
Any members have any further questions of Winston? Winston, I just would like to say, this has been a long meeting, but it's been a good meeting, and it just shows the amazing work that you and your team do at Kentucky Housing, and certainly we're all impressed with the work you all do, and thank you so much. So,
thank you.
With that, if no other members have any questions of Winston, I'll move on to items from the board or staff that are not on the agenda. Does anyone have anything that they would like to bring up today? Okay, so if not, Mr. Brown, I'm sure that I want to welcome you to the board, and I'm sure you got a little bit of information in regard to what a great organization Kentucky Housing is and what an amazing job they do. And so we're glad to have you on board. And any way we can help you in any way, please call us. All right.
Thank you.
I want to thank the board members for staying with us. I know a couple had to leave early, but we certainly appreciate it. With that, I'll entertain a motion to adjourn. Please, someone.
So moved. So moved.
All right.
I'll make that motion.
So we have a motion and a second. All in favor, say aye. Aye. Thank you all so very much.
Bye, everybody.
Bye.
Recording stopped.